Study Objective 4 is going to get into the specifics of deferral adjusting entries. Remember, there were two kinds, deferrals and accruals. This is all about deferrals. It's a very important study objective, as is number 5. It goes through a bunch of specific cases where cash changes hands first. Prepaid expenses is the type of deferral situation where we pay money, our company pays money in advance, and then we have to record entries to as we use up those expenses. So you're going to want to pay particular attention to the examples that they go through in this section of the book. So they start talking about supplies. That is an example of a prepaid expense adjusting entry. You buy the supplies in advance, all right, with cash, and then over time you use the supplies up. All right, so this goes through talking about, well, you use up supplies. What's the effect on the accounting equation of using up supplies? What kind of adjusting entry do you have to record the usage of those supplies? You'll notice that we debit an expense account. We always debit expenses for the amount used up, and we credit the asset supplies because we need to reduce the asset. We don't have that amount of assets anymore. And it continues on through with other types of prepayments as well. Insurance is a prepaid item, and that is going to require the same kind of prepayment adjusting entry where we record expenses as we use up the insurance. Depreciation, same category. It's a prepaid expense, even though in this case we're buying assets that have a long life, and we have to spread the cost of those assets over the whole life. So we record little bits into an account called depreciation expense. It's just like insurance expense or supplies expense. We're just putting a cost as we incur it into the expense account. You'll notice here, though, we don't credit the asset itself. Office equipment, we credit this different kind of an account. It's called a contra asset, known as accumulated depreciation. You'll see how this kind of fits into the balance sheet a little bit later on. But we credit accumulated depreciation whenever we record depreciation expense. You can see the statement presentation talks about how how the asset will look on the balance sheet. You'll see the equipment and then an immediate reduction in the equipment for the amount of depreciation that's been taken life to date on that asset. Book value. Here's a discussion of book value. This is not what the asset is worth as time goes by. It's simply an amount that's amount to use to describe how much of that asset has yet to be depreciated or expensed. Unearned revenues are also prepaid adjusting entries, but this is where we're receiving money in advance and then we go earn it. So we record a liability, unearned revenue, and then we'll see that as we earn it, we have to make an adjusting entry to record the revenue. So you'll see here in this adjusting entry, we credit the revenue account because we've earned it now. Remember, the revenue recognition principle says record the revenue, aka credit revenue, when you earn it, and we will debit or reduce the liability when this happens, when we earn the revenue. You can see now why it's so important to understand the idea of debits and credits and what the effect of debits and credits are on all the different types of accounts, because you need to use those concepts all the time. So follow through in this book depiction of prepayment adjusting entries. It goes through a pretty good example here, and we'll get to study objective 5 next.